Okay, today we're helping business owners move beyond simply filing a return and start to think strategically about the money they're earning, spending, and building. Today I have Warren with me. He is more of a tax strategist versus someone who just files your taxes. So explain that a little bit, Warren. What's the difference between someone who prepares your taxes and someone who helps you to strategize?
Sure. Well, good to be here with you. So what we do tax strategy wise is really where someone puts the emphasis, right? We still prepare tax returns, but we kind of view the tax return as that necessary evil at the end of the planning process, right? So if you plan, then the last step in the plan is to get the tax return filled out correctly according to the plan. Whereas somebody who comes in, you come to get your taxes prepared, you dump a bunch of information on them. He's sitting there cranking away, does the best job he can with the numbers that you gave him, but isn't really involved in what's going on to know, ask the right questions, or even set you up ahead of time so that we can get the
Mhm.
best results. There's a lot of things we can do so long as the year hasn't ended yet. Once the year
Mhm.
is over, things are kind of locked into place, and we still have a few tricks up our sleeves, but it's still limited to what we can do after the year is over.
So when's the best time for someone to meet with you about their taxes?
Tomorrow,
Or yesterday?
yesterday, I'm being
Right?
generous. Tomorrow will work.
Um, you told me when we first met that some of your wealthiest clients pay the
Right.
least amount of
Pay
taxes.
the least amount of taxes. And that's
Okay.
why, and we do have a saying here, our slogan at our firm is paying your fair share is for suckers.
Yeah.
So, and, and it sounds cool, but where it really comes from is I got tired of having that argument with people that the wealthy don't pay their fair share. I
Mhm.
don't, whether you want to argue with that or not, the concept is that you believe there's somebody out there who's not paying their fair share, quote unquote, the wealthy. Well, the tax code is fair, meaning it treats everybody the same. That
Mhm.
is, so long as you do the same things. So if you did the same things as, let's say, Elon Musk, you'd get treated the same way as Elon Musk. So the tax code is a respecter of actions, not a respecter of persons. It doesn't care who you are. It doesn't care what color you are. It doesn't care what religion you are. It doesn't care where you live. It doesn't care. All it cares about is what you've done.
Mhm.
And so if you do the right things, you get treated the right way. And to me, that makes it fair. And so if you believe there's somebody out there who's not paying, quote unquote, their fair share, well, then you simply just need to do the same things that they do.
Okay. Do you see that every person that comes to you that there's an opportunity to be a little more strategic?
Everybody who has a business. So let's put it this way. We
Okay.
talked about when the first time we talked about my favorite thing. Remember that those puzzles that we did when we were little kids, where they were as it was a picture with a bunch of tiles, and you had to slide the tiles around to make the picture. So
Hmm.
kind of picture doing a tax strategy that way. We slide everything around to make the tax picture that we want to see. But
Hmm.
in order to slide something around, we have to have at least that one open space that allows us to move things. And that open space is, for the most part, having a business. Now, it could be a side business, right? You could have a really healthy W-2, but you still have something going on, a side gig or something that's still going on that gives us that open space. We can start moving things. And another thing that gives us open spaces is doing some significant investing, like in rental real estate or things like that.
Okay. So let's go back to the side hustle or the side business. How much income does that need to generate for it to be viable, to be something that you can actually use and run opportunities and strategy through it to save money?
Well, there's not really a number to it, right? So the
Okay.
most important thing is for the IRS to consider it a business, you have to have a profit motive.
Okay.
And that's pretty much all it says. I know some people say, "Hey, what about that 4 out of 5 year rule or whatever? If you have to have a profit at least once out of it."
Okay.
Those aren't in the law anywhere. They might be good rules of thumb, but basically, you don't have to have a profit to have a business. I mean, let's look
Okay.
at all those years of Twitter that existed. I think before Elon Musk bought it, I don't know if Twitter ever had a profit, but I don't know that anybody would ever consider Twitter not a business.
Okay.
So so you you just have to have the intention to make a profit. You're allowed to be a bad business person, right? You're allowed to
Okay.
not know what you're doing and still have a business. Uh, but if you have losses coming over and over again, you should show that you're doing things differently. Like, okay, what have you done to try to fix it? And sometimes those things you do to try to fix it might actually lead to more deductions.
Okay. Okay. So I have friends in two different camps. They're either entrepreneurs and they're like always coming up with the strategies to look like they make nothing at the end of the year. Or I have friends who make a lot of money and they're more in more corporate jobs. Um, and they have to make more money to keep more money. For those people that make a lot of money, who maybe they have their wife is stay at home, or maybe the husband's a stay at home, what kind of businesses could they start to help with to help with getting some tax advantages?
Well, one of the biggest things is if we can create paper losses, right?
Okay.
Real losses, and we can talk about that. Real losses are good. You know, if we can start deducting some of the things that we're already spending money on,
Yeah.
we can connect them to a business, that's a good thing. Even better is if we can do paper losses. And you mentioned a key piece to that is one of the spouses is stay at home or maybe works part-time or something like that.
Okay.
So one of the magic components is rental real estate. It's huge. It's a great tool that we have because we can create paper losses with it. And what I mean by paper losses is there's a deduction that we get in rental real estate, especially in rental real estate, called depreciation.
Hmm.
Depreciation is a non-cash expense. It's just based on the purchase price of the property.
Okay.
So let's say you have a rental property that gives you positive cash flow of $5,000 a year.
Hmm.
But let's also say that we have depreciation of $15,000 just to make up a number. For tax purposes, then we would have a $10,000 loss, even though we put $5,000 in the bank. That's what we mean by a paper loss. It's not a real loss, it's just one on paper. Now, there's hoops to jump through, and we can maybe get into that or maybe not, of how we actually get to deduct that $10,000.
Hmm.
And in worst case scenario, let's say we can't deduct that $10,000 immediately. We will get to someday, but maybe we can't deduct that extra $10,000. And then somebody says, "Well, this is no good. I can't deduct that $10,000 yet." So they're overlooking the fact that they put $5,000 in the bank that they didn't pay taxes on.
Hmm.
So it doesn't make the W-2 go, the big W-2 from your spouse go down, but it does put $5,000 tax free in the bank.
Okay. Okay. How does that play? So you're talking about depreciation. How does bonus depreciation work and fit into that?
So bonus depreciation, that, that just blew up the calculus on this whole thing. So normally, if you have a residential property, you have a
Mhm.
residential property, we get to depreciate it over 27 and a half years. So that means we take whatever you paid for that property, we break out a little bit something for the land because even the government's not crazy enough to let us depreciate just land, it just sits there.
Okay.
But we break a little something out and then we take the rest and we divide it by 27 and a half. That's how much you get to depreciate every year. Now that's the rule for real property, for the building itself.
Okay.
But really, when you buy a rental property, a rental house, or an apartment complex, you're buying more than just the building. You're buying a lot of personal property. And personal property we can depreciate over just 5 or 7 years.
Okay.
Personal property is defined as anything that you can remove without causing damage. So it's going to be things like kitchen cabinets and appliances and countertops and ceiling fans and window treatments and certain kinds of flooring and specialty lighting, shelving, all these kinds of things that you can remove without causing damage. Now, I know if you watch, any of those fix and flip shows, and the rehab shows. We're kind of addicted in my house to them, but they take a sledgehammer to everything, so everything gets damaged. Technically, that's just for drama, right? They don't have to
Okay,
do that. They
right.
can pull those things out intact. At least that's what the IRS thinks,
Okay.
which is the important part. So we get to depreciate all those things over 5 years. There's also, or seven, some of it seven. There's also a category of things called land improvements. I said we couldn't depreciate land, but we can depreciate the things we've done to the land. So those are pretty much everything that's outside. It's like landscaping and irrigation, sidewalks, driveways, walls, fences, pools, patios, even gravel outside, right? Just how crazy it is in Arizona. We get to depreciate gravel because that's landscaping.
Okay.
So all
Okay.
of that stuff we depreciate over 15 years. The significance to that and bonus depreciation is since we had the one big beautiful bill pass, we made this a permanent thing, which says anything that has a life of 20 years or less, so both of those items that I mentioned qualify, we can write off 100% of the year we put it in service rather than depreciating over its useful life.
Okay.
So
So
for
not
example,
the structure, not the home, but the
the
content
contents
that
of it,
could be removed from that
right?
structure.
And if it's
Okay.
furnished, all that counts too, right?
Yes. Okay. Okay. So if you purchase an Airbnb that has been used as an Airbnb and you purchase that and it comes with the furniture, you can depreciate all that furniture that came with it.
Right. Or if it didn't have furniture and you buy
And you
furniture
purchased it.
for it, you
Okay.
can write it off. But yeah, so that gives us and just kind of as a rule of thumb, it varies wildly. But if you have a single family home, we can usually see about 20 to 25% of that purchase price, maybe a little bit more if it's a nicer property, count as bonus depreciation that we get to write
Okay.
up right away. So basically, let's do easy math and say you bought a property for $100,000. Let's make it $200,000.
Okay.
Then that's about $50,000 deduction immediately the date you put it in service. So if you had a property that broke even, so your rent equaled all of your expenses, so it broke even, we would then show a $50,000 loss for tax purposes.
I love that. Okay, so that loss though doesn't translate as you no longer say your tax liability is 50,000 and you have that loss of 50,000. That doesn't mean you're paying zero taxes.
Correct.
Tell me what that means. If you have that loss, what does that translate to as far as the amount of taxes you have to pay?
So instead of saying $100,000, instead of saying $50,000 of taxes, let's say you have $100,000 W-2
Mm-hmm.
now, and nothing else is going on,
Mm-hmm.
and we have the $50,000 of depreciation. It now means your income is only $50,000 instead
Okay.
of $100,000.
Okay. So it could potentially put you in a lower tax bracket.
Right.
And so you're paying less. It just depends on how much your income is. It
Right.
lowers your income.
Right. And like we started off, or you started off by saying that some of my wealthiest clients pay the least amount of taxes. I've I have clients that have made in the millions of dollars, but they've done this little house that we talked about here, but 100x. They might have bought have a 50 to 100 unit apartment complex, so we blow that number way up. And even though their business might have generated $1 million, they ended up, if they wanted to, probably qualifying for food stamps.
So wild. My family did when we were growing up, and I think it was part of all of this stuff. My dad's an architect, developer.
And then to boot, you've got, you talked about we before we started talking, we talked a little bit about retiring things, and it's like just think. I mean, yeah, there's 401ks and all these retirement plans, right? But how about a retirement plan that gives us tax deductions for investing in it, well, like a 401k, but again, real estate, right? Real estate we can usually finance like 80% of, so 20% down, maybe even a little bit less. So we get that ratchet, right? So to buy a $200,000 property and get my theoretical $50,000 deduction, it
Mhm.
doesn't cost you $200,000 cash out of your pocket, right? It's more like 30 or $40,000.
Okay, so you can finance the property and still get the depreciation
Right.
and get the loss.
Right. And it's going to grow. They're hopefully
Mhm.
going to grow in value over the years. Your tenant's going to help you pay the mortgage off on it, and you do this over and over again. Uh, Forget about what your 401k or your other retirement plan says. You now have 15 or 30 little income producing properties that are all paid off,
Right.
giving you a monthly income every month that maybe you're not even paying taxes on because we have write-offs.
So if someone is curious or interested in purchasing a property and doing something like this as a tax strategy, they should probably start thinking about that now in August if they haven't done it already.
Right. If we wanted to count for 2025, if this is important for 2025, which a lot of people, I'm sorry, 2026, I'm
Okay.
still working on 2025 extensions for people. So if you're working now, uh, yeah, we want to get it done before the end of the year so we can get it placed in service. Bonus depreciation is really cool. We get that deduction even if you put it in service on December 31st, right? We get it
Okay.
that whole amount for the whole year. Normally, if we had depreciation and we did it on December 31st, we'd get like 1 day's worth of that divided by 27.5. So
Oh, really? So it
we
doesn't.
don't,
Okay.
yeah. Real estate's what's they call straight line depreciation. So we look at how many days you had it for that year to get the normal depreciation. But when we're looking at these bonus depreciation numbers, it doesn't matter when you get it in service, just get it in service.
That's wild. So is this bonus depreciation tax law sticking around for a while?
Well, it's made permanent now. Originally, when it first came out, it was supposed to have ended last year.
Okay.
And then in the
Still
one
here.
big beautiful bill, they came back and made it as permanent as anything can be in Washington, right?
Yeah.
Until
Yeah.
another Congress and Senate come and change all the rules. But
Okay. Well, I'm sure we'll come back to some of these other things, but I want to talk about hiring your children in your business. It's one
okay,
of the most talked about strategies. It shows up a lot for me on my social media, and I know my feed kind of feeds me what it knows that I have kids. It knows that my kids work for me. It knows that I've like clicked on some things and watched things. But when is hiring your children actually a smart strategy, and what rules must business owners follow to make it legitimate?
sure. So yeah, it's one of the greatest ideas. When you should do it is when you have a business and you have kids under the age of 18.
Okay.
Then it's a no-brainer. We just have to figure out how to do it, right?
Okay.
Uh, so basically, reason why. So where do I start with this one? Uh, we want to hire our kids, right? Because most of the time our kids are in a lower tax bracket than we are,
Yep.
right? Maybe even at a zero tax bracket.
Okay.
And
Yep.
if our kids are at a higher tax bracket than us, then maybe they should hire us to do stuff for them. But
Yes.
if they're so it's a way of transferring money out of your higher taxes to
hmm
their lower tax bracket.
hmm hmm
Uh, it's roughly is, I'm not going to get this number right. It's a little over $15,000 a year before they have to pay any tax at all.
hmm
So if you had two kids, that's $30,000 we can take out of your tax bracket and put it in their zero tax bracket. And then
hmm
any more than that first gets taxed at just 10%. So it's still probably better than where most of us are at, except for my really rich clients, and that would be
Okay.
at a higher tax bracket. But
Okay.
uh, so hiring your kids just for moving that money, reason one, to get a better tax bracket.
hmm Okay.
Reason, but there's a bunch of other really good reasons for it. Reason number two is now they're employees of your company. And if
hmm
you're doing something for your company, maybe if you're taking a trip, they can now be included as employees. And so on that business trip that you're going to take, you need
hmm
to take more staff with you so you can cover them being on that trip and pay for it and deduct it as business travel. Uh, a friend of mine's kid when he was in like third grade, came back from summer and started third grade in school. You know how schools always do, they what did you do during summer vacation kind of thing. And he complained to his teacher told his parents this at their conferences. He complained that he doesn't get to go on vacations, he has to go on business trips.
That's hilarious.
And so we can if they're employees, we can cover them that way. There's also another really cool thing, and I have a good story for this one. Uh, so a business is allowed to deduct education expenses for their employees, or themselves or their employees, so long as it teaches them to do a better job of what they're already doing, or it meets some legal criteria that they need, like for an accountant, I have to have 80 hours of continuing education, so to keep my license. And so that that would count. But if I took a class just to teach me how to do a better job of my doing the job that I'm already doing, then that's also a deductible education expense. So here, let me give you a quick story, maybe a quick story. You know me by now. Sometimes we're not so quick, but uh, and this was actually before I started my own company. I was working for somebody else, and we had this really cool client because she knew the right way to ask questions. So let me tell you this. This is
Mhm.
a side bonus here. Uh, when you ask your accountant or your lawyer or any professional, don't
Mhm.
ask them how can I do, or don't ask them can I do this. Ask them how can I do this,
Okay.
because often us professionals like to take the easy way out and they say, can I do this? And you say no.
Okay.
Instead, say, how can I do this?
Yes. Okay.
And so she had a kid who was in high school, and he was really into computers, and him and his buddies started getting into trouble because they were like hacking into stuff and doing some things they
Mhm.
shouldn't be doing with a computer. And her being an entrepreneur thought, I want to channel that energy into a more positive direction. And part of that is she wanted to send him to computer camp to learn more about computing. So
Okay.
naturally, she came to her accountant and
Mhm.
said, hey, this is going on with my kid. How do I, not can I, how do I deduct me sending him to computer camp? And so we thought
Okay.
about it. And we said, well, what if you hire your son to be your IT person?
Yeah.
And she says, well, he does help me with keeping my network going and stuff like that because he's really smart at those things. So if you hire him to be an IT person, so that's computers, right? And I send him to camp, which is really training
Mhm.
on computers. So therefore, I'm teaching him how to do a better job of what he's already doing. So therefore, my business can pay for it. So we got to deduct it. And I said this was a really good story. That part's a good story. But here's where it becomes a really good story is she was in a networking group, kind of similar to BNI, if any of you guys know
Okay.
about that one. She was in a networking group, and some of her people there asked her, "Hey, who does your IT work? We need help." And she said, "Well, actually, it's just my son." And they go, "Oh, well, can we hire your son?" And so again, because she was a smart entrepreneur, came back to us, her accountants, and said, "How these my friends want to hire my son? What should we do?" So we formed an LLC for her son,
Okay.
and he had his own IT consulting LLC as a high school kid. And so he started then billing out her friends to work for them. And so that made it a better story because now it's okay, we got the deduction. Now your son's an entrepreneur too, starting his own business, but it gets even better because so mom and dad were divorced. Dad lives in Hawaii. Summertime, her son would always go to Hawaii to live with dad for a few months to surf and do all that kind of fun stuff. And
Mhm.
so as it was getting closer to the end of the school year, he said, "Hey, Mom, have you made my reservations to go see Dad yet? When am I going?" All of a sudden, she said, "Well, wait, son, you can't go to Hawaii. You've got a business. You got clients that are dependent upon you. You until you figure that out, you can't go anywhere." So he went back to school, talked to all his computer buddy friends, hired a few of them to come take care of his clients, and then he got to go to surfing in Hawaii while his friends were working, getting paid from him, but running his business for him while he was off surfing. So that makes it a great story. All because mom wanted to know how do we get to deduct some
Ah,
education expenses for her son.
how can we instead of can we? How
Yeah.
can we? I love that. So, should you pay your children as a 1099 or as a W-2 then?
Great question. So we want to pay them as a W-2, especially if you're a sole proprietor. So there's a special little tax break. If you're a sole proprietor
Okay.
or a
I have a
part,
lot of loan officer clients that are sole proprietors.
so
So
if you're a
listen up.
sole, okay,
Okay.
so if you're a sole proprietor or even a partnership where it's you and your spouse or the parents of the kid, right?
Okay.
And if those are the only two partners, but usually it's a sole proprietorship. If you're a sole proprietor and you hire your child who's under the age of 18,
Mm-hmm.
they are exempt from payroll taxes. And payroll taxes is, the Social Security and Medicare that gets withheld from a paycheck, and the employer pays half, the employee pays half. So
Okay.
you're exempt from that. If you
Okay.
paid them on a 1099, they now are they are themselves a sole proprietor, and they have to pay self-employment tax on that income, which is the same thing as payroll tax. So a 1099 will actually cost your kid more money than if you paid them on a W-2.
So if you paid them as a W-2 though, in your example of the child who owned the tech company,
Right.
he was, I'm assuming, getting payments from people as a 1099 contractor.
Right. But from his mom, he stayed on a W-2.
Okay. Okay. Can someone switch from a 1099 to a W-2? A
Sure.
child.
Sure.
Can it go
So
switch
if you
back?
started,
Ever?
so if you started off paying your kid as a 1099, uh, two choices. One, let's say it's mid-year, right? So and it is right now. Let's say you start it in January, paying your kid, and you're just planning on giving a 1099 at the end of the year. You can just call a payroll company,
Mm-hmm.
tell them, hey, I need you to do a paycheck for my kid. Here's how much I've paid him this year. And here's the great part again, right? Since they are exempt from payroll taxes, they can prepare they can prepare those W-2s for you at the end of the year, and you're not going to need to put any money in for payroll taxes because there isn't any. And we just won't he just won't have any withholding for that year. But
Okay.
so yeah, working with the payroll company is really important on these things.
Mm-hmm.
We're a CPA firm. We understand all this stuff. I use a payroll company because it's not worth my time and effort
Yeah.
to pay one.
Okay. Okay. We have so many things to cover. I want to keep
Okay,
moving.
sorry.
No, so we've heard there's so much with the kids. So I think you need to meet with a tax strategist if you have children and you want to maximize your money and what you keep.
And there's at
Uh,
least three other good things that happen when you hire your kid, but we'll save that as
quick.
a teaser.
Okay, at the very end. Okay. Okay. So tell me a little bit. Let's talk for 2 minutes about the Trump accounts, the benefits of them and what happens. I know that children born within from January 1st, 2025 through what is it, December 31st of 2028. If you're born in that time period, you can get 100 or $1,000
Thousand.
seed money, $1,000 seed money from the government to put into a Trump account.
Right.
Talk to me about those Trump accounts, the pros and the cons.
So if you have a child born in that time period,
Hmm.
it's a no-brainer. You want to do a Trump account. It costs you nothing to set up, and they pay your kid $1,000.
Okay.
So why wouldn't we want to do it?
Yep.
It's
Okay.
a free $1,000. I know nothing's free. It came out of people's taxes, but it came out of
Yeah.
your taxes too. So at least get
Yeah.
$1,000 back from
Okay.
it.
What
Uh,
about if you're a child under 18? You can't turn 18
right,
um, during that time.
right. If you're already a child, if you're already born before the $1,000 came, opening a Trump account, it's a good idea except for if it in the scenario that we just talked about where you hire your kid. When you hire your kid, we don't need the Trump account, right? Because now your kid's going to have earned income because you're going to pay them something and they're going to have earned income. That means they're allowed to set up an IRA for themselves. They can
Okay.
set up a Roth IRA, they can set up a traditional IRA, they can set up whatever they want and kind of don't need to jump through the Trump account hoops
Okay.
because they already get it because they have earned income. But let's say you have a kid who doesn't work doesn't have earned income. A Trump account, this is the way I picture it, right? A Trump account is really an IRA for a child with no earned income. Because without earned income, you're not allowed to contribute to an IRA.
Okay.
But you can contribute to a Trump account. It acts just like basically like a Roth IRA till they're 18. So we might, if you have a kid who isn't going to be working for a little bit, and so they don't have any earned income, and you have some spare income you want to put towards the future of your child in a retirement account, then that would be a place to go. I would I would much prefer you start or have a business and hire and employ your kid because we get all the other benefits as well as being able to put money into their IRA.
Okay. And how much can you put into a Roth IRA at this point annually
You
for a
caught me
child?
on a number.
I think it's 7,500, right?
Yes, I believe you're right.
Okay.
7,500.
Okay. Would you highly recommend maxing that out if they've earned enough to max
Yeah,
it out?
if they've earned the money, if they've earned enough, and and you could spare the money, right?
Yeah.
Obviously. And the thing with getting a Roth IRA set up as soon as possible for your child is there's a clock that starts ticking with a Roth IRA, and the clock
Mhm.
starts ticking the day you open the account. It doesn't matter how much you put in it, the day the account opens, the clock
Okay.
starts ticking. When we get to 5 years, you could take out all of the contributions without any taxes or penalties. You can't take out the growth.
Okay.
So let's say you put in $5,000 a year for 5 years. That's $25,000. Let's say the account's worth $32,000. After 5 years, you can take out the 25. You have to leave the rest in there.
Okay. Can you take it out for any reason, or does it have to be for education or a home or
And
medical expense?
any reason you want to.
Is that just with the Roth IRA, or does that include a traditional IRA?
Just the Roth
Just
IRA.
the Roth. Okay.
So it's kind of an escape valve, right? We hopefully don't want to ever take that money out because it
Right.
keeps growing tax free, not tax deferred. But you put the money in, and okay, after 5 years, if worse came to worse and we really needed the money, I can get to it without any penalties.
Okay. Say money is really no object. Say you're working with a really wealthy client and they have two kids and say one's 10 and one's 12. What are the steps you would encourage them to do before the end of this tax year on what to do for those children and
So
with
first,
those
we
kids?
we want to hire them again.
Okay.
We're
Hire them.
stuck on that. We're going to pay them. We're going to get them. If they want any kind of training or things like that, we're going to be careful about what job we select, that we say they're going to do for us, because
Okay.
that's going to affect what kind of education we can pay for.
Okay.
We obviously want to make sure it's a job that they're qualified for, right? We
Yep.
can't if they're 3 years old, we can't really say they're your bookkeeper.
Right. Right.
Although
Yeah.
some books I've seen, you might believe it, but so we
Okay.
gotta be reasonable with it
Okay.
always. But uh, we want to look at something that they can do, and then know that as an employee of your company, and this is a good segue into other things business owners can deduct, right?
Hmm.
As a business owner, you're allowed to deduct anything that's ordinary and necessary for your business.
Okay.
And I translate ordinary and necessary to mean this. Anytime you spend any money,
Hmm.
if what you're spending that money on can benefit your business, then it's deductible. If
Okay.
it's not, then it's not deductible. But you're still allowed to get personal benefit from something so long as we can connect it to somehow thinking that this is going to benefit your business. And we
Okay.
can expand that to things that we're spending money on for our kids. If they're an employee of the company, or those things, is there a way to connect to those back to say it's going to benefit the business? And it's your opinion. It's your opinion that it's going to benefit the business. It's not the government's opinion. It's not anybody else's opinion. As a matter of fact, you can choose a ridiculous idea and still think it's going to benefit your business. I mean, everybody else might just laugh at you and say, that's the stupidest thing I ever heard of. But if you believe it's going to benefit your business, it's deductible.
Okay.
It might
What's the
require a little documentation if it's super bizarre. Like you might want to take some notes, we call them minutes, uh, and say why you decided to do that. You thought it would help your business, but
okay.
we're good.
So I have some clients who do a rental clothing company called Newly, and they need it because they do speaking engagements or they have networking events, and
Oh,
they like to have new, fresh clothes. So they look professional on a regular, and they have paid for their employees to use the same rental company. Is that is that a business expense?
yes. So, wow. Um, Somebody stole my idea. So,
What?
no, so I had a client. So I had a client, I won't say who it was, but she was kind of a famous speaker.
Okay.
And one of the things she was known for is like every time she came back on stage after every break, she had a different outfit on.
Okay.
And it was really, really important for her to be able to deduct her clothes.
Okay.
And it was more of a personal thing, right? She really wanted to be able to deduct her clothing expense
Okay.
and didn't care how much effort and work we did to be able to do that. And normally, clothing is not deductible.
Okay.
We can't do, even if you say, well, I never wear a suit and tie, but I have to wear it for work. No, the rule says if it's acceptable for you in society, if it's acceptable for you to wear whatever it is outside of the business purpose, it's not deductible, right? So you may never
Okay.
choose to wear a suit outside of business, but it's not unacceptable to wear a suit.
Okay.
So it's not really considered a uniform or a costume. Now, if you put, and this is why you see some crazy people take, I've seen people with dress shirts and they embroider the name of their company on their dress shirt. So now
Yeah.
it's like now it's a uniform. Now I can
Okay.
deduct it. So if it's that worth that much to you to be able to deduct a dress shirt, there you go. Embroider your name on it. Uh, Polo shirts with the names, all those things, those all become deductible. But in this case, we had the idea of saying, all right, what if it's not your clothes? What if you're renting those clothes, as well as the other stuff? Like she had like PA equipment and projectors and all that kind of stuff you travel with when you have a seminar business or a speaking business. And so we just made a separate equipment rental company, and some of the things that we included in that equipment that we rented was wardrobe stuff.
So she rented it from herself.
Yes, from her own business.
Interesting.
So if somebody else is doing that, because I know I thought of that all by myself because I was really proud of myself that day. And so if she went and told somebody else about it, which she probably did, and then some other CPA stole it, now I'm kind of mad. But that's okay.
Well, there's rental companies that you Rent the Runway is one of them. Newly is one. I think there's other clothing companies, but a lot of my friends rent Newly. So that would be a totally legitimate thing.
Okay. Yeah. So if you're renting it for a specific business purpose, I would say it's deductible.
It
If you
would be
bought
okay.
it, it wouldn't be.
Okay, gotcha.
Okay.
Talk
Sorry
about
for the
V.
misunderstanding.
Oh no, that makes total sense. I like that. I like both of those options. Those the one thing I want to talk about is cars, vehicles.
Okay.
What's the best way to maximize, like if you need to purchase a vehicle in 2026, what's the best strategy to purchase that? And say you have young drivers coming up, those employees of yours, those children. How does that work as well? Can you give us a quick answer
So,
on purchasing a car and then perhaps your children getting one of those vehicles that you're
so,
purchasing?
so bonus depreciation counts not just in real estate. We talk about it all the time in real estate, but it counts for things you buy, business equipment that you buy too.
Okay.
And so buying a car in the name of your business gives you the ability to deduct it and
Okay.
take bonus depreciation on the purchase price. There is a there is a limit. Congress put this thing in place several years ago to stop evil businesses from deducting luxury cars.
Okay.
They didn't want you to be able to deduct a luxury car, and so they couldn't determine how do we say what a luxury car is compared to a regular car. They said, well, by the amount you pay for it. Back then, it was like $12,700 was a luxury car. So if it ran, it was a luxury car, and it's gone up a little bit since then, but not a whole lot. Uh,
Okay.
and then they said, well, some businesses do buy vehicles that cost a lot more than that aren't luxury cars, are actually like really working vehicles. So we
Right.
want to be able to let them deduct those. So how do we do that? And then someone came up with the idea, oh, well, let's go by the weight.
Mm-hmm.
So if they have a 7,000 pound gross vehicle weight, so it's not
Hmm.
curb weight, it's gross vehicle weight, which is fully loaded down to whatever the manufacturer spec is, of 7,000 pounds or more, we're exempt from that luxury car rule.
Okay.
And so this was the weird thing. So at the time, a car that cost 13, there's only two cars back when they created it that weighed more than that, regular street cars. It was a Chevy Suburban and a Rolls-Royce Silver Shadow. And so basically, government logic said a car that cost $13,000 was a luxury car and a Rolls-Royce was not.
That's funny. Doesn't make any sense, does it?
So if you're going to buy a car and
Mhm.
if you're going to get a car, I should say, and it's going to be more than 7,000 pounds, really for tax purposes, really consider buying it, not leasing it.
Okay.
Uh, you want, in order to qualify for the deduction, you need to drive it at least 50% of the miles for business. So it's
Okay.
going to be important that you drive at least 50. It doesn't
Okay.
matter. I had somebody buy a car on December 31st. They drove it probably 50 miles that day and 30 miles were for business. We still got to deduction because it was more than half for the year.
Okay. Um, so purchasing, what happens if you purchase that vehicle, but maybe you gift it to your child someday or stop using it for business purposes? How does that work?
So depending upon what the value of that car becomes at with the time you take it out of service, there might be a tax hit for that. But
Okay.
if you're doing that, that probably means you have bought yourself another car to replace that with,
Yeah.
so that hopefully the depreciation, the bonus depreciation we get on the new one, more
Okay.
than offsets the income that we might have to pick up from doing something with the other car.
Okay. We are getting so close to being out of time, but I wanted to talk about uh, when should a business elect the S corp,
Oh,
elect to become an S corp? When does that make sense?
you asked the best question. So every business should not be an S corporation. So
Okay.
so many people, sometimes I'm really weird and I love to get on debates with these guys on social media who are promoting S corps for all causes. Uh,
Okay.
every business should be an S corp. Absolutely not. Uh,
Okay.
we want to be an S corp when it makes the most sense to be, but we don't want to do it sooner than it needs to be. So the only reason in the whole world, at least from the tax side, maybe someone else has got another reason, but from tax purposes, the only reason ever to be an S corporation is to reduce self-employment tax. Remember, we
Okay.
talked about that extra 15.3% tax that you
Mm-hmm.
have when you're a sole proprietor.
Mm-hmm.
S corporations is a special loophole in the rules, and we won't get into all the details of it, that allow us to reduce it. We can't get it to zero, but we can maybe cut it in half or better.
Okay.
Uh, so that's the only reason to be an S corporation. When it makes sense, and it depends on what state you're in, but Arizona in particular, my rule of thumb is when you have a profit of about $60,000 or more, that's the time to start talking to your tax person or talking to me about
Okay.
becoming an S corporation. You're allowed, if you have an LLC already set up,
Mm-hmm.
and you want to become an S corporation, we can make an election to make it retroactive to the beginning of whatever year we want to, so long as the LLC was in existence. So if you started an LLC, back in 2024 or 2025, and you're cruising through this year and you go, oh man, Warren just said if I'm making more than $60,000 profit, I should be an S corporation. Well, I'm making about $100,000 profit. Dang, it's too late. Nope. it's August. We can still make that election retroactive to January 1st of this year, and you could be an S corporation.
Okay. Say the person's making 100,000. What would that save them in taxes?
Mm,
And,
roughly about $20,000 ish.
okay. So that'd be
Uh,
well worth looking into
It'd
if
be
someone isn't.
very well worth looking into. The caveat is if you're straddling, so if you have a W-2 job and a business, if you're making too much money in your W-2 job, meaning like $90,000 or more on your W-2 job, we probably don't want to be an S corporation until your W-2 job goes away.
Okay.
And we don't have to get into why, just trust me on that one.
Okay.
If you have a high W-2 and you become an S corporation, you will end up paying more tax, not less.
Okay. Who do you think of all these people in America who could use like use strategy the most? Who are those people? Is it the person who is a W-2 and has not figured out write-offs? Do you think that there's more opportunity for them, or is it the business owner?
It's definitely the business owner.
The business
So
owner. But the W-2 person could open up a business.
could open up a business, right? And those are some of my favorite people to talk to are people who are just getting started in their business. Those guys, I mean, guys who have been around for a while, they're still good. We can still really help them, but it's kind of fun working with that people who are just starting to flex that little entrepreneurial muscle. And
Oh yeah. So my son kind of is entrepreneurial. He's cutting palm trees this summer. He works for me as my financial person. He's got a lot of stuff going on. I think he needs to meet with you to kind of talk strategy as he's entering into his life.
absolutely.
I think there could be some opportunity for him to set himself up to pay less taxes.
And just to plant a thought in people's head, like we had talked about several times, my favorite thing to talk about is social media influencers.
Yeah.
What a great category of potential business because I was telling you, I have a client that makes a couple $100,000 a year just posting pictures of her Frenchie all over social media. Uh, so it is possible to make serious money doing that. The vast majority of people won't. But
Okay.
again, if you have a profit motive, you're one of those people who wants to, maybe now all those things you're doing to create content to drive traffic to your site, those guys, those all become business expenses because building traffic, getting eyeballs on you is what makes you make money.
Right. What other little businesses have you seen people open besides the social media? Obviously, the rental properties is a business. Are there any other little things that could get people's brains turning?
Right?
Okay.
Consulting in any various areas. Like if you're a W-2 somewhere, maybe you've now developed some expertise somewhere and you can consult somebody else. And
Okay.
that works on the side uh,
Okay.
as well. I'll give this away. So I haven't tried it yet, but this would be an interesting experiment. I almost don't want to tell people about it because I want to try it first. But uh, a guy I know had a very successful business exit. He created a business, sold it for a lot of money.
Okay.
Probably has enough money to live off of, but he got bored and didn't want to just sit there. So he wanted to create a business. He didn't want the headaches of this business he had before. So he used AI. He went out on ChatGPT and he said, "Hey, give me a list of businesses that I can start that can be profitable, that require no employees, and I can eventually automate. So give me those business ideas." And it gave him a whole list of them. And then he worked on narrowing it down to five. And then he had it create the business plan for those and then create the business. So he basically had AI create those businesses and create how to do them and basically ask AI how to get AI to do those for him. And so basically I said, you just started three businesses. You're still going to be bored because now AI does it all for you, but now you're just making money again.
Well, he can be busy managing his money and
Right.
making sure his AI guys aren't broken and the
And
bots are doing their job. That's really interesting. That's getting my brain turning. And I don't want to share my secrets of what I'm thinking, but I love that. I think that's a really good thing to task your kids to figure out too.
Absolutely.
Like,
So great job for kids. If you want to hire your kids, make them your webmaster.
mm-hmm.
Kids understand that stuff so much better. Your social media manager, they understand that so much better because they always say, right, that your website, somebody comes to a page on your website, that a third grader should within 1 minute understand what the business is and what the call to action is. So what's better than having a third grader actually do it?
Mm-hmm. Yeah, and with AI, they can now.
Right.
Okay, we have like 2 seconds left, so I have a question, and then I'm going to do like a rapid fire questions for you. But what is the Augusta rule? I hear a lot about it. What is the Augusta rule, and when can a business owner legitimately use it? And then we'll transfer to our fire questions, rapid
Okay.
fire questions.
Legitimately is the key question. So first of all, it has nothing to do with Augusta. I like to say it does because it tells a really cool story. But
Okay.
basically, when you have a rental property,
Okay.
there's some de minimis rules, meaning small enough that the IRS doesn't care. So
Okay.
if you have a rental property and you use that rental property for personal use for 2 weeks or less, they say, we don't care. We're going to ignore
Okay.
the fact that you used it for 2 weeks or less. The
Okay.
other end of that spectrum says if you have a personal property and you rent it out for 2 weeks or less, we don't care. And you don't have to count the rental income as income. You don't get to deduct any expenses for it, but we're going to pretend like you didn't even rent it and you just get to keep that money.
Okay.
So that's where the Augusta rule comes from, is people saying, well, what if I rented my own house out, but not to a stranger? I rent it out to my business for some kind of business purpose. So then the business deducts that rental expense, and I don't have to pick it up as income because it's under the Augusta rule.
Gotcha. So if I rented my own home and had like a team meeting here for 2 weeks,
Right.
or I did a photo shoot here every day for 2 weeks, I could pay myself 10 grand for the week, for
Right.
each week, and that would be not taxed.
It would be a tax deduction to the business and tax free to you and personally. So the business would have a deduction and you don't have to pick up the income. Now, this is the part I always tell people. We say legitimately, like, so people just think they can just do this without, you're going to need to document this like crazy, because that IRS agent that's sitting across the desk from you, if you get audited, that's my say is, can you explain the business use, the business purpose of you paying that rent to yourself with a straight face to the IRS agent?
Okay. Do you think that that would raise your chances of getting audited if you used that strategy?
Uh, if so, this will sound weird. If you do it correctly, it would. It could. Put it this way, because when when you do it, you're still supposed to include that rental income. So let's say you pay yourself $10,000 a year.
Okay.
On Schedule E, which is where we report rental real estate, we still show that $10,000, and then we show a subtraction from it citing that rule,
Okay.
so that we're basically telling the IRS what we did. So
Okay.
now, if you just left it off the return entirely, that would technically be incorrect, but it wouldn't raise any red flags because nobody knows.
Gotcha. Okay. So that one's talk to your tax
Yeah,
strategist on that one.
I
Talk to
mean,
you or your tax
it's
strategist.
one of those fun things. It's one of those fun things who people talk about too. It's like, hey, I'm going to write off my dog as security for my home office, or my cat as pest control for my home office. So we say all those things, and those are kind of cute, uh, and they're fun to say from stage when you're doing seminars, but
Yeah.
they really don't add up to a whole lot of money. And yeah, and you're walking a tightrope.
Okay. Okay. Good to know. All right. So always consult with your tax strategist on making any decisions. This is
And
all
here,
conversational in this talk today, right?
right, and
Ideas.
here's something too. Just because you hear it on the internet or you read it in a book or
See it
whatever,
on TikTok.
or see it on TikTok, you should never, I shouldn't say never, you should hesitantly take tax advice from somebody who's not also willing to prepare and sign your return. Because as a tax preparer and someone who signs your tax return, I'm subject to preparer penalties along with you maybe being
Okay.
penalized for doing something. So it's kind of a little bit of safeguard. You don't need to have them do your return, but if they're not willing to prepare your return at all, take their advice with a grain of salt.
Okay. Okay. Good to know. I think that's a good transition into our rapid fire closing. Okay, my friend, I'm going to list
Rapid
some
fire.
things, some ideas, and I want you to say smart strategy, it depends, or TikTok tax advice. Maybe we avoid. Okay. All right. So smart strategy, it depends, and TikTok. All right. Hire your children.
It's very smart.
Put your children's earnings into a Roth IRA.
Very smart.
Buy a vehicle before December 31st.
Also smart if you need a new vehicle.
Okay. Pay off your mortgage.
TikTok.
Take the home office deduction.
Very smart.
Hire your children as models for your company marketing.
Also smart.
Hold company meetings at your house.
Hold company meetings at a nice resort.
Okay. Put a newborn in a Trump account.
Yes.
Max out an HSA.
Yes, definitely yes.
Change from an LLC to an S Corp.
Depends.
Buy equipment at year end.
Only if you need equipment.
Combine a business retreat with a warm weather getaway.
Of course.
Okay. I like it. All right. I think we
You're
covered a
tuned
lot.
into the best TikTok channels.
Yep. All right. We're going to end it with this. What's one tax move every business owner listening today should ask their CPA or their tax strategist about before the end of this year?
One thing you should do before the end of this year, and usually end of October through November is the time to do it, is do some year-end planning. Talk to your tax person. Even if they're not a strategist, hopefully they can do this for you. Give them your year-to-date tax information. Let them do some projections. We have tax software that lets us do projections, and it also lets us do some what-if scenarios. So we can, in November, guess about how much income you're going to have for the rest of the year, and then say, what if I did buy that new vehicle, or I did this, or I funded my retirement account, or all these different things? What will my tax result be? We used to be
Okay.
able to do that in our head, and now it takes software to do it. But
Okay.
that's definitely worth every penny they're going to charge you to just get that one last shot at what we can do before the end of the year.
Okay. So between now and October, it's really important to have that conversation, to get that
Exactly.
scheduled and to have that. Okay. I love it. All right. So don't wait until April 15th of next year. Don't wait till December 31st of this year. Make an appointment. And I know you have office hours or something on Thursdays. Tell
Yeah.
us about that. And is anyone invited?
Sure. So we decided we don't mind answering quick questions for people, right? So people would send us questions. There's 9 of us here at my office, and people pepper us with questions all day long, and we started not getting any work done because we had so many questions. So we thought, what if we take an hour out of every week and just do a conference call just to answer people's quick questions? And we do that every Thursday at 3 o'clock Pacific time.
Okay.
Uh, you can, me
You'll
and somebody,
you'll give me the link so I can put it
yes,
in the
we'll give you the
podcast.
link so that you can log in. We
Okay.
just ask you for your email address and your name, but you
Okay.
can come on the call, ask questions. There's people that are this nerdy, like, so we're so nerdy here, but there are people that actually call in every Thursday just to hear everybody else's questions. So if you're really bored on a Thursday afternoon and want to hear accountants talk about taxes, jump in and listen. If nobody asks us any questions, we stop talking and go back to work. So we're on there for at least an hour. We're on there for an hour if people keep having questions. If they
Mhm.
don't, then we go away and start working again. But please take advantage of that. That is the single best thing you can do before the end of the year, is get onto that call and
Mhm.
get your questions answered or hear other people's questions that might stimulate something for you.
I have the same thing. I offered on Tuesday, so I'll enter both of those links. So my business is a little different than yours. I don't know anything about taxes, but I'm all about building relationships for the clients that we work with and making sure that everyone remembers your name. So we want our clients to be the trusted advisor with whatever they do and that their clients are loyal to them. So I have office hours on Tuesdays. So we're just giving away all this free advice, free
Perfect.
advice.
Yeah, givers gain.
That's right. All right. So my friends, thank you so much for joining Warren and I. And make sure you don't wait until December 31st. Don't wait till April 15th. Get on it. Meet with Warren or meet with your own tax strategist.
Perfect. Thanks. This was fun.
Thank you again for joining us today on the Driven Podcast, where we are all about growing relationships in life and business. We hope today's story reminded you that behind every brand, every business, and every big idea, there's a real person choosing to show up, stay rooted, and lead with intention. Your story matters. So keep building, keep loving, and keep doing the hard, beautiful work of showing up in both life and business. We'll catch you next time with another real, inspiring conversation. And until then, never let love and kindness leave you. Always be a fountain, not a drain. And don't ever forget that you are the best.